Okay, let's start. Okay, good evening and welcome to the final TRG for this paper MA. Okay, so I am aware that there are some of you in the call and some of you who are watching this either in the LMS or on YouTube. Okay, so wherever you're watching this, whenever you're watching this, MA, just one thing I have to say on this last day to you is MA is not a paper where there is a timeline. Okay, because you decide when to sit for the paper. It's entirely your choice. Okay, so in a situation like that, I have seen time and time again, I have seen students, they are perfectly ready for the paper. Okay, if they do a mock exam, then definitely they score in the 70s and the 80s. And even though they are reasonably comfortable. Okay, so now if you're 100% comfortable, obviously you have to score 100 marks. Nobody gets there really. Okay, because in every paper there will be some area where they test, and you wouldn't have seen that anywhere in the past. Okay, so sometimes you can get it right, sometimes you won't get it right. That is normal. All right, what I have to say to you is, if you're a student where you're done with your lectures, you are done with the entire revision kit at least 2 times, you know what's going on in the revision kit, you know your mistakes well, and if you sit for a new mock exam, you get at least 70 or 80 marks, then the best thing for you to do at this point is, now if you're getting 70, you're not too comfortable, just sit for 2 more mock exams and go ahead and book for your exam as soon as possible. Okay, don't delay that, because I'll be honest with you, we are human beings, right? So more than you spending more time delaying your exam and trying to learn more, the more obvious thing that will happen is, in that extra time that you're taking, you're going to forget what you already know. Okay, we are humans, we forget. Okay, so don't think that, okay, if I delay this paper, I will be able to learn more and I'll be able to perform better. No, everybody has a capacity. Okay, if you feel that your capacity is reached, you have done your best and you're getting an okay mark, 70s, 80s, ideally, then don't think too much. You're never going to really, learn so much that when you do a paper, you're going to get 96. Okay, that's not going to happen. That kind of thing happens at your exam only if you know all areas, and at your exam, obviously, you will be more focused. Okay, when you're at home and doing a mock exam, the level of focus that you have is anyway a little less. Okay, so if you can reach the 80s, then definitely with extra focus in your exam, 90s are not going to be so difficult. But if you keep on delaying your exam by months and months, just thinking that you have to do better, you have to do better, what you already know, what you're already good at, you will start forgetting. And to get it back, that's going to be a different, a totally different battle for you. Okay, so that is my only piece of advice. Know when to draw the line. Know when you are comfortable. At that point, book for exam, sit for it, and that's it. Okay. And besides, this is MA, guys. So these marks really are at the skills level. To some extent, the marks will matter when it comes to your OBU. But the knowledge level, the marks don't really matter. Okay, so I'm not saying aim for 51. Okay, aim for 80 at least. That will definitely do good for your motivation. But it's just going to be that. Okay, so don't try to just waste time with MA. Okay, so we want to be in a position where we have enough time for our skills, enough time for our professional level. We don't want to come to a position where, we're trying to rush those papers. Because those papers, actually, there are prizes, there is the OBU degree, there are actual reasons to, aim for a really high mark. But this paper, if you're comfortable, if you're happy with what you know, then please go ahead and sit for it. Okay, right. So today, let's move on with the last set of mixed bank questions. So in case there are some of you who have joined recently or you haven't been there during the beginning of the month. So what we were doing, these TRGs, simply I had about 100 MCQ questions. And those 100 MCQs, they came from all areas of the syllabus. So it was not only from one chapter, it was from a mix of chapters. Okay, so it was always like a mix. So what we did, from day one, we started with mixed bank 1. There were 5 mixed banks. We started with mixed bank 1. We are done till 3. And I took one extra day simply just to do variance analysis, because some of you are having issues with that. And I know that if I didn't teach it, no matter what I do with the questions, it's going to be difficult for me to, make you understand it. So that's why I took a day for variances. And now finally, we are in the last day, mixed bank 4 and 5, we are trying to complete it. And hopefully, if you have done your end, what you were supposed to do, if you have done that well, you should be in a very comfortable position at this point. Okay. Right. So let's start. Mixed bank 4. So it says here, most businesses assess the performance of management. So that means they will check on the performance of management. Which of the following is most likely to lead to short-termism? Okay. So what is short-termism? It is basically a situation where your managers, they take decisions just thinking of a short-term benefit. Okay. So maybe if they take a particular decision, profits will increase this year. But maybe in 10 years' time, that investment is not so great because for some reason, let's say, the peak will only happen for 1 or 2 years. The third year onwards, everything is going to go, downwards. So in a situation like that, if you want the company to do well, it's not a good option to go for that investment. Yeah, this year you will earn, next year you will earn, but thereafter you're not going to earn, right? So it's better to avoid that kind of an investment. But if the manager feels that, no, I'm going to go for this because I want the profit to be high this year, maybe his bonus depends on that profit. Next year, maybe he will go to another company, so it doesn't matter to him. So in that case, what will he do? He might go ahead and invest in that project. So what has he done? He has taken a decision keeping just the short-term benefit in mind. He has not thought about the long-term benefits. Okay. So for a shareholder, if a manager is going to think in the short term, it's always a bad thing. Because if the shareholder wants the company to run for a long time, then the decisions that are taken today, it has to be taken thinking about the long term. So if managers you are hiring are not going to do that, then that is a very bad sign for the shareholders. Okay. So they're saying here, which is most likely to lead to a manager taking a short-term decision? A, linking managers' rewards to share price. Okay. So if you link your manager's reward, his bonus, something that is, you're going to give him most probably a bonus, you are linking it to share price, means if the share price increases, you will pay him more bonus. In that situation, now you must understand share price is not something that will just increase overnight. Okay. Only if the business is doing really well, will a share price increase. So for a business to do really well, you can't only take short-term decisions. You have to think about the long term also. Okay. So if you link the manager's reward to share price, then the manager is compelled to think about the long term. Okay. Because only if he takes decisions that are good for the long term, share price will increase. Only then he will get his reward. So A actually leads to long-termism, not short-termism. Setting quality-based as well as financial targets for managers. So if you're going to give quality-based targets and financial targets alone means it can lead to short-termism. The manager might try to do something to make just the profit figure high. But if we are going to give them a target based on quality as well, then they have to, look at both quality and the quantity. So that is kind of a good balance. It won't really lead to short-term decisions because we are focusing on quality as well. Setting cost-cutting targets. Okay, so if you're going to set a cost-cutting target, let's say we are saying you have to make a production of say 100 desks and the budget is this much, $10,000. You can't go up any more than that. So when you do that, suppose the manager is not able to, achieve it in 10,000. He puts a budget and he says, no, I'm not able to do it in $10,000. What he will do is, chances are that he might reduce the quality of the raw material. Okay. Or he might reduce the quality of the output. He might start, hiring unskilled labor so he can pay a lower labor rate. Those kind of things he might do. And what will happen? Your product will take a hit on quality. Because for the manager, he has a target, a cost target. He wants to achieve that. He will do whatever it takes to achieve that. So for the manager, if the target is achieved, good for him, he will get his bonus. But what will happen to the brand name? What will happen to the image of the company if, we start outputting goods with low quality? For the long term, that's not good for the company. So C is something that will lead to short-termism, because he's not thinking about the long-term image of the company. He's just thinking about his short-term target. Okay. So C is the answer. Last one, making short-term targets realistic. If you make a short-term target realistic, meaning he can achieve that target, then why is he going to try to reduce quality and stuff? He wouldn't, right? He will try to make sure that whatever he does, he does it with the quality as well as achieves his target at the same time. So if it is realistic, that won't lead to short-termism. So the answer there is not D, it will be C. Right. 22.2. Which of the following best describes TQM? So what is TQM? It's called Total Quality Management. Okay, so it's a newer, a newer methodology where we don't think about cost at all. We don't think about cost at all. We focus on quality. Okay, so what are we trying to say? We want to make sure that whatever we do, we get it right the first time. Okay, we want to continuously improve our product. So we are very product centric. We don't care about the cost. We don't care about anything other than the quality of the product. Okay, so what happens over here, what we believe in TQM is, now we can't run a business without thinking about financials. We have to think about financials. If not, it means that you're running a charity. Okay, but what TQM says is true. We don't think about financials too much, but we are focusing on quality now. Okay, so that will speak for itself. That's what we are trying to say. We are focusing on quality. Our product, there is nobody in the market who has this kind of product. Okay, we know that maybe our costs are high, maybe our selling prices are high, maybe we don't have that many showrooms. Okay, we may not be marketing our product. We don't care about all that. What we believe in is, if we put a quality product out to the customer, definitely in the long term, not in the short term, maybe in the short term, we won't see the benefit really. But in the long term, people will associate our brand with quality. Okay. So the moment that happens, automatically everything else will fall into place. The financials will happen. That's what TQM believes in. Okay. So let's see which one describes it. Identifying the factors which cause the cost of an organization's major activities. Identifying factors which cause major activities, the cost of major activities is more to do with activity-based costing. Okay, where you have different costs, you find out what is the cost driver, factors that are causing these costs. So that is activity-based costing, not TQM. Applying a zero defect policy to the management of all resources and relationships within an organization. That is TQM. We want to have a zero defect policy. Our quality has to be top notch. Okay, we don't want to compromise on our quality at all. Okay, so that is the answer B. Let's see what C is describing. Tracking and accumulating costs and revenues attributable to each product over its life cycle costing. That is, and estimating product cost by subtracting a desired profit margin from a selling price, that is target costing. Okay, so they have described all the alternative costing methods in these 4 points. Okay. Right. J company makes a product which passes through a single refining process. The following information is available for June. We have materials, labor, normal loss, and scrap value of the loss. The output for the period was 13,000 kilos from the process. There was no opening or closing inventory during June. What is the value credited to the process account for the normal loss and the abnormal loss for the period? So they're asking you for the value of the normal loss as well as the abnormal loss. So I'll give you about 5 minutes. You can see if you can figure out a way to get the value for normal loss and abnormal loss. Okay. Okay, so let me show you how to do this. This is a very classic process costing question. Okay, so when it comes to process costing, always make it a point to have two columns. Okay, one talking about the kilograms, the other one talking about the monetary value. So what does it say here? It's saying that materials, okay, we are inputting 15,000 kilos. 15,000 kilos at 1.5 per kilo. Okay, so the total value of this 15,000 kilos is going to be 1.5 into 15,000. That is 22,500. Then we have labor. Labor, they're saying it was 2,100. Okay, and then we're talking about the losses. So first, before we do anything, let's take totals here. Okay, so I'll just take a total here. This will be 15,000 and this will be 24,600. Okay, 15,000 and 24,600. So that's what we are expecting. Okay, and then to this, we are expecting a normal loss of 10% of the input. Okay, so we have a normal loss. That's going to be 10% of the input, means 10% of 15,000. So that is 1,500 normal loss. We can put it as a negative figure. Okay, and this 1,500 kilos, basically, it can be sold at a scrap value of 56 cents. Okay, so let's see how much we can sell it for. 1,500 into a scrap value of 56 cents means $0.56. So we can sell it for $840. Okay, now this $840, you have to understand this, right? It is an income. It's an income, but we deduct it from this 24,600 because 24,600 is a cost. Material plus labor cost is 24,600. 840 is an income. So an income will reduce a cost. Okay, so 840 will actually contribute towards reducing this 24,600. So that's why we deduct 840. Okay, and then we can get what we call an expected output. So 15,000 minus 1,500 is 13,500. 24,600 minus 840 is 23,760. That's what we are expecting. Okay, so for normal loss, the value, it will be 840. So the answer should be either A, B or C. Okay, not straightforward at all. A, B or C. Now let's talk about the abnormal loss. Let's see what the actual output is. They're saying the output for the period was 13,000 kilos from the process. So output is 13,000. Now what happened here? We expected an output of 13,500. Okay, we expected an output of 13,500, but the actual output was 13,000. So we have got less than what we predicted. So the amount that we got less, how much less by, I mean, what's the difference between the expected output and actual output? That will be an abnormal loss. Okay, because we expected 13,500, we got only 13,000. So we have lost more than what we expected. So that's why it's an abnormal loss of 500 kilos. Now the question is, how much are we going to value this 500 kilos at? Now what you have to remember, an important point is, abnormal loss or abnormal gains, you can't value it at scrap value. Only normal loss you can value at scrap value. Abnormal loss, you have to value it at the full cost per unit. So over here, you can calculate a cost per unit figure. Okay, so how much is that going to be? 23,760 divided by the total number of kilograms, 13,500. The cost per unit is 1.76. Okay, so this 500 kilos, you have to value it at 1.76. So the total value will be 500 into 1.76, which is $880. So abnormal loss, you will have to evaluate at $880. Okay. So the answer is, for normal loss, we're talking about 840. And for abnormal loss, we're talking about 880. So the answer is A. Okay, A. You can take this down if you want. Okay, let's move on to the next one. Okay, it's a long question. We'll see what it says. Let me keep it in case you want to copy. Okay, so it says here, gold company makes and sells two products called the A and the U. Okay, the following information is available for me. We have production, A and U, and sales for A and U. Both are given. Then they're giving us the costs. Product A selling, first they're giving the selling price. The selling price is 85 for A and 60 for U. And then they're giving us the variable cost, the direct materials, direct labor, variable production overheads. Then they're saying the fixed costs were 75,000 for May and are recovered on the basis of direct labor hours. There was no opening inventory for either product. What is the profit reported for May using marginal costing principles? Okay, so what is the profit reported for May using marginal costing principles? Right, so let's start this off. We're talking about the profit for May. Okay, so it's like an income statement that you have to do. So first, let's start off with the sales. Okay, let's start off with the sales. What do we have? A and U. Those are the two products. So let's talk about A first. The sales for A is 4,300 units. And the selling price of A is 85. Okay, the selling price is 85. So let me write it over here. 4,300 into 85. So that will be 365,500. That is A. U, we are selling 2,600 units. And the selling price was 60. So that will be 156,000. So we can take a total over here for the sales revenue, which is 365 plus 156, which is 521,500. Okay. Now, in an income statement after sales revenue, the next one is obviously the cost of sales. So let me just write over here, cost of sales. Usually we start with the opening inventory, but here we don't have it. So let's move directly to the production. Okay, so how many did we produce? For each there is a different production units as well. A is 4,500, U is 3,100. So let's look at it individually. So first let's go for the variable costs. Okay. So what are the variable costs for A? Variable cost. So A, okay, first we'll take the units. Production for A is 4,500. We have to multiply it by the total variable cost. So let's take a total here. Direct material 20, direct labor 15. So that will be 20 plus 15, 35, plus another 15. It will be 50. 20 plus 15 plus 15. The total variable cost is going to be $50. So you can put the total itself. You don't have to do separately. So 4,500 into 50, that will be 225,000. And then let's look at U. The number of units that we produced is 3,100. You multiply it by the total variable cost, 10 plus 18, 28 plus 20 is going to be 48. Okay, 48. So that will give you 148,800. Okay, you can take a total here. This one plus this one. 373,800. Now, from this total, you have to deduct the closing inventory. Okay, so let's type closing inventory. Closing inventory. Okay. So for A, what is the number of units? We produced 4,500. We have sold 4,300. So in our inventory, we will have 200 remaining. Okay, we'll have 200 remaining and we will value that at 50. Okay, because of the variable cost being 50. So that will give you 10,000. Okay. And over here, we produced how many? 3,100 and we sold 2,600. So the difference is going to be 3,100 minus 2,600, which is 500. We'll value it at 48. So this will be 24,000. Right? Now, here you can take a total as well. It's going to be 378,800 minus 10,000 minus 24,000, which is 339,800. Okay. Let me bold this figure and underline. Now, selling price minus variable cost, all variable costs, they give you a total. In marginal costing, we call that contribution. Okay, so you should remember that it's contribution. So let's get the answer for contribution. 521,500 minus 339,800, which is 181,700. That's the contribution. But we can't stop there because they are asking us for profit. So when it comes to marginal costing, from the contribution, you deduct all the fixed costs directly. We don't try to take OARs or anything. We just take the full fixed cost figure. How much is that? 75,000. We just deduct it here itself. Okay. So then we get the profit, which is 181,700 minus 75,000. So that is 106,700. Okay. Marginal costing, this is how it works. Simple. You avoid the fixed cost until you come to contribution. From that point onwards, you can just deduct the fixed cost and get the profit. Just in case you want to know, if this was absorption costing, then over here, after variable cost, you will have to have fixed overheads as well. There'll be another line saying fixed overheads, and you will have to take an OAR, multiply it with the actual labor hours. They're saying they're using the basis as direct labor hours. No. So you need an OAR. So you take 75,000 divided by the budgeted direct labor hours. You get an OAR, multiply that with labor hours, and there will be a total over here. For fixed overheads, it will be there separately. Okay. But for marginal costing, we don't need to do that because we don't need any OARs or anything as such. So this is a profit statement. It's an income statement. Again, they can ask you to do it. Okay. They can ask you to present it like this. But of course, they can ask you to do the calculation and just give the answer. Okay. Okay, so let's move on to the next one. It's to do with variance analysis. Okay. So I hope at this point you are comfortable with it. Let's read through. It says last month, Z company purchased 750 kilos of raw materials for 13,500. The material price variance was 1,125 favorable. What was the standard price per kilogram of the raw material? Okay, now whenever you see variance analysis, first get the equation straight. Okay, so what do we have equations? Yeah. So there are three boxes. We know one is actual. The other one is actual at standard. And the third box is standard. Okay, actual at standard, standard. Each of them have their own equation. So this one is actual quantity into actual price. This is actual quantity into standard price. And here it is standard quantity for actual production into standard price. Standard quantity for actual production into standard price. Okay. And here, the difference between these two boxes will give you the price variance, and the difference between these two will give you the usage variance. Okay. Now, what have they told me in the question? They are saying, we purchased 750 kilos of raw materials for 13,500. The material price variance was 1,125 favorable. So, we already have the variance. They're saying the variance was 1,125 favorable. They're asking you, what was the standard price per kilogram of the raw material? So, they're asking you this figure, standard price. Okay. So, based on what we have, we know that the actual quantity is 750. And the actual price we don't know, but we know that it gave a total of 13,500. So, to get actual price, that is very simple. Okay, actual price, all you have to do is 13,500 divided by 750. So, the actual price that we paid is $18. Okay, 750 into 18. Okay. Now, here also we have the actual quantity 750. We have to multiply it with standard price, which we have to find out. Okay. But we can work backwards and find out the total because we already have the variance now. So, when we compare the two, it's a favorable variance means the actual is lower than the standard because this is a material variance. Okay. So, that means actually I have spent 13,500. If the variance is a favorable variance, then according to the budget, this box has a little bit of standard now. According to the budget, they would have allocated a higher budget. Okay. How much higher? It will be 13,500 plus 1,125. Okay. So, 13,500 plus 1,125. Right. So, what has happened here? One second, let me just check. 13,500 plus 1,000. I put 16,000 here, sorry. This is 13, okay? 13,500 plus 1,125. So, the answer is 14,625. So, what that means is, according to my budget, I was allowed to spend 14,625. I have spent less, 13,500. I have spent less. Spending less is a good thing. So, that is why this variance was a favorable variance. Okay. So, now if I want the standard, then 750 into something should give me 14,625. So, if I write it as an equation, into the standard price should give me 14,625. So, if I want just the standard price, that is going to be 14,625 divided by 750, which is 19.5. Okay, so the standard price is 19.5, which is D. Okay, you have to be careful because depending on whether this is adverse or favorable only, you will decide whether you have to add this 1,125 to 13,500 or subtract it. Okay, so always think this way. Okay, if it's a favorable variance, actual is lower than the budget. So this number has to be higher than this number. So for that to happen, you have to add 1,125 to 13,500. Okay. So variance analysis, it won't always be straightforward. They can even ask you to work backwards. You should be able to do everything. The key is that you know these equations very well. If you know it very well, then the chances of you not being able to do variance is 0. I'm telling you, it's 0%. If you know the equations well, then most 100% of the time you will be able to do all the questions. Okay. And I have shared the slides for variances as well as a summary for variances on the Telegram group. So make it a point to have a look at it. And it will be easy for you to learn. Okay, so I have summarized everything in like 2 to 3 A4 sheets. It will be a lot easier for you to learn than, going through pages and pages of notes. Okay. Right. So you can take this down and then we can move on to the next one. All right, so let's do the next one. Under which sampling method is the population divided into categories? Okay, so what is sampling? You should know. When you have a population, meaning you have a lot of people, maybe, for example, you can't, and you want to do an interview, you can't go and interview each and every person individually. What you try to do is, let's say there are 1,000 people, you just take a sample of maybe 10 from that 1,000 and conduct whatever interview you're doing. Okay, so let's go through each of them. How does systematic work? So systematic is like this. Let's say you have 1,000 people, 0, okay, all the way to 1,000. Okay. What you do is you use a random number generator first. At the beginning, you use a random number generator, and whatever number that comes, let's say the number is 25, you select the 25th person as the first sample. Okay. After that, you can choose your samples in fixed intervals. So let's say we want our intervals to be 10 people. Then from the 25th person onwards, you can decide the 35th one will be the next sample. Then the 35th plus 55. Likewise, up to 1,000, you can keep going. The gap between the samples will be 10. It will be fixed. So you might have a question, who is deciding this 10? You decide it. Now, if you want 100 samples, then maybe you have to go for gaps of 10. If you want 50 samples, then go for gaps of 20. If you want only, you want only about 20 people, then go for maybe a bigger gap. So the gap is decided by the person who is conducting the interview. So that is the systematic sampling. Quota sampling is very simple. We don't divide or anything. We just stand in one place. And if we have a quota of, say, we have to interview 200 people, then the first 200 people that come near us, the first 200 people that you see, you interview them, and that's it. Okay, so we don't try to divide, or there is no any sort of system. Okay, it's a completely random sampling technique. Then we have random sampling. How that works is, let's say again we have 0 to 1,000 people. Now in systematic sampling, we use the random number generator only to get the starting point. But here, let's say we want 10 people. Okay, we want 10 people as the sample. Then what you have to do is you have to use the random number generator 10 times. Okay, input the numbers. The starting is 0, ending is 1,000. And then using the random number generator, you have to do it 10 times. And the 10 numbers that you get, they will be the sample. Okay. Finally, we have stratified. Stratified is like this. Not stratified, stratified. Stratified means, let's say, for example, we have 100 people. Okay, what we do is, first, if we see that there is, some sort of a category happening here. For example, let's say of this 100, 60 were women and 40 were men. So that's a very clear categorization, right? Women and men. So what we do is, before we get the sample itself, we will divide the categories into women and men. And then, let's say our sample is 10 people, we will make sure that this initial ratio 60-40, we maintain it in the sample as well. So we will make sure that there are 6 women and 4 men in our sample. Okay, so the question is asking in which method are we going to divide into categories? Only in stratified sampling will we do division of categories. Okay, so the answer will be D. Right. The price index for a commodity in the current year is 125. Current year is 125. Base year is 100. The current price for the commodity is 31.50 per kilo. What was the price per kilogram in the base year? So they're saying in the current year, today, this commodity, the price is 31.5 per kilo. And they're giving you the price index numbers. Okay, they're telling you current year is 125, base year is 100. Now, keeping those 3 pieces of information, they're asking you, in the base year, what was the price per kilo? So that's actually very easy. All you have to do is take this 31.5 and multiply it by the price index of the base year. Okay, so base year is actually, it's called P0. So we multiply it by 100 base year and divide it by 125. Okay, so how this will look like is 31.50 multiplied by, open brackets to be safe, 100 divided by 125. So that is 25.2. Okay, so the price of this commodity in the base year would have been $25.2. Okay, so if you can't remember the equation, if you remember there was an equation, price index numbers, it goes like this, P0 over P1. Okay, so P1 means we are talking about the current year. P0 means we are talking about the base year. So 31.5, that's the price. We multiply it by P0, which is the base year 100, over P1, which is the price index of the current year, which is 125. Okay, so the answer is 25.2. All right. 2 statements follow about data and information. So the first statement is saying data is a scientific term for facts and figures. Sounds correct to me. If it's a fact, it's a figure. It's not processed, then it's called data. Information is data which has been processed. That is true. Okay, so 1 and 2, both are true. So answer is B. Both statements are true. Then it says D forecast cost using the model y equals a plus bx. The intercept is 20. When y is 270, then x is 50. What's the value of the gradient? Okay, so it's you can't get a simpler question than this. Plus bx. Okay, so what you have to understand is this is the same as in mathematics we do y equals mx plus c. In mathematics, you would have seen this, right? What do you call it? An equation of a line is called y equals mx plus c. So what is m? M is the gradient. What is c? C is the point where the line touches the y-axis. Y-axis. It's called the y-intercept. Okay. So what we have done in accounting, we always like to do this, right? We always change letters. We change names. We call it the income statement. We call it the P&L. Then statement of comprehensive income. Like that, we just keep changing. Okay, so here also we have just changed the letters. Instead of M, we have put B, and instead of C, we have put A. Okay, and then what did we do? We didn't like C to, A is the first letter of the alphabet. No, so we don't like it to look like BX plus A. So what do? We bring it forward and we call it A plus BX. Okay, that's all we have done. So if they are giving us the figures for A, X and Y, it's easy for us to find B, which is the gradient. Okay, so what are they saying? They are saying Y equals 270 and X is what? 50. And what else? The intercept means A, right? A equals 20. And they're asking you for the gradient. They're asking you for B. Simple, just substitute the figures. Okay, so 270 equals to A, which is 20, plus B is what we want to find, multiplied by X is going to be 50. Okay, B into 50. Okay, so you can rearrange this. It will look like this. 270 equals to 20 plus 50 into B will become 50B. Okay, then 270, 20 to this side, minus 20 should equal to 50B. And 270 minus 20 is 250 divided by 50 equals to B. Okay, so B will be 5. This one. Okay. Before we move on, I'll just teach you something really quickly, okay? Because I don't want you to waste time in your exam. I always teach this to my students. Whenever you have an equation like this, okay, like for example, this equation 270 equals 20 plus 50B, there is one variable that you don't know. We want to find out B. Okay, so usually what do? We will rearrange the equation and get B. But if you have a scientific cal, you can use the function in the cal itself at this point to calculate B. So how you do that is like this, right? 270 alpha equals sign. Just, I'm just putting the equation as it is in the cal. 20 plus 50B. So I don't have B in the cal. So instead of B, I can just put alpha X. Alpha and this bracket sign, okay, X. Usually on top of the bracket sign, if there's something in pink, that means when you press alpha and press the bracket, then the actual thing that comes in the cal won't be the bracket, it will be what is in pink. Okay. So 270 equals 20 plus 50x. Now what do we want to do? We want to solve for x. So what do? Press shift and solve. It will say solve for x, press the equal sign. So immediately you get x equals 5. So you instead of wasting time rearranging, and there is a chance that you can rearrange wrong, all of those things, it gets eliminated. You directly arrive at the answer itself. Okay. So wherever you find yourself having an equation like this with one variable, always use the cal directly. Okay. It will save you tons and tons of time. Right. 10 and 11. Okay. So let's go through this question as well. The following information relates to questions 22.10 and 22.11. LMB company produces and sells one type of product. Okay. The details for the last year were as follows. We have production and sales budgeted actual figures. There was no inventory at the start of the period. Selling price and costs are also given, budgets and actuals. We have selling price per unit, variable cost per unit, fixed production overheads, and fixed selling costs. Question is, what would be the actual profit for the year using marginal costing? So actually, we did this. It's a repetition. Yes, how to do it in the cal, I'll repeat it. Okay, so what you have to do is, if this is your cal, you need to just put in the equation as it is. Okay, as it is. So what's the equation? 270 equals 20 plus 50b. Type it as it is. So 270 equals means, if you see in your cal, on top of this calc button, you will have an equal sign in pink, right? So that means you have to press alpha and that calc button. That will give you the equal sign. You can't press this one. It will give you the answer. Okay, so 270 equals 20 plus 50, and to use x when you're using the cal. If you want to find a figure, that's unknown, you can't use just any alphabet, use x. So what you do, press alpha again, and x is this closing bracket button. On top of that, you have a pink x. So you have to press that. Now, once you have put in the equation, don't press the equal sign. It won't be able to solve. what you have to do is, can you see on top of the calc button again, there's option saying solve. You have to use that. So solve is in yellow. So first you have to press shift because that's the yellow one, and then press the calc button. It will say solve for x. Press the main equal sign in your calc. You will get the answer for x. In this case, it's b. B is 5. Okay, that's how you use the calculator. Right. So you can try this out. What could be the actual profit for the year using marginal? And the other one is, what will it be if you're using absorption? So in this question, we are doing it both ways. So I'll give you a minute. See if you can figure it out. Okay, so let's start with marginal costing. So as always, it's an income statement. Like I said, you have to start with the sales. Okay. So where sales is concerned, how many units are we selling? 25,000 units. And we are selling at a selling price of 80, right? Yeah, 80. So the sales figure is 25,000 into 80, which is 2 million. So let's just do this in thousands, okay? Whenever you see so many zeros, it's easier to do it in thousands. So let's do everything in thousands. So I'll just make this not 25,000. I'll make it 25. You can do it in millions, no problem. But it'll just take a lot of time and effort, right? You miss a zero or something. Unnecessary. So that's the sales. Then next you have to have the cost of sales. Okay, we don't have any opening inventory. What are the variable costs? They're saying that according to the budget, the variable cost is 60. So that's what we use. But we have to multiply the 60 by the production. So the production is how much? 26,000. So to get variable cost, it's going to be 26,000 into the variable cost per unit, which is 60. So that will be, let me take a total here, 26 into 60, which is 1,560. To this, you have to deduct the closing inventory. How do we calculate closing inventory? Okay, there is an equation. It goes like this. Closing inventory equals to the production plus the opening inventory minus the sales. Okay, so there is an equation like this. You have to know it, right? Obviously, closing inventory, what we have at the end of the month is what we produced. Plus, if we had any opening inventory at the beginning, that also you have to add minus whatever we sold. That is what will end up as closing inventory. Okay. So what is the production? It was 26,000. We did not have any opening inventory. So that is 0 minus the sales was 25,000. Okay. So the closing inventory is 1,000 units. So that will be 1,000. You multiply, obviously, closing inventory, you will value it at the marginal cost. What is marginal cost? 60, variable cost. Okay. So that will be 1000 into 60, 60,000. Since we're doing it in thousands, let's put it as 60 minus 60. Okay. So 1560 minus 60, you can take a total here. Which is 1500. Okay. Let me put it here, 1500. Now, 2000, which is the sales, minus 1500, it will give you the contribution, which is 500. Now, from this, you have to deduct all the fixed cost. What are the fixed costs that we have? We have 113,000, which is production overhead, and a fixed selling cost of 69,000. Both you have to consider when it comes to the fixed cost, because this is the final deduction before profit. Okay. So 113,000, put it as 113 plus 69. So that is 182. That's the fixed cost. Finally, to get profit, you have to take the contribution, 500 minus 182, which is 318. So 318,000. Answer will be B. Okay. So remember, when you're doing marginal costing, you will value your production, your closing inventory, everything under the cost of sales. You will value it at the marginal cost. So what is marginal cost? Only the variable cost per unit. Okay. And of course, in the income statement that you should know, you use the budgeted figures. Okay. Right. So the same thing, let's try to do it under absorption costing as well. Now, usually, if you're going to do this under absorption costing, I'll show you that as well. All you have to do is, in this question, we don't have the information, but I'll just show you how it has to be done. This production overhead of 113,000, sorry, this production overhead budgeted 143,000, that amount, you have to divide it by an appropriate base. So that could be maybe labor hours, for example. So budgeted total labor hours, let's say that was 50,000. You will take 143,000 divided by 50,000 and get the OAR. Once you get the OAR, you will multiply that by the actual labor hours, and you will have, after variable cost, you will have a fixed cost element where we take the OAR and multiply it with the actual labor hours. But in this question, we don't have any information about labor hours. Okay, so the only way we can find the costing according to the principles of absorption costing is by converting the marginal costing profit to absorption costing profit. So we have the marginal costing profit. I'll type it here. We know that the marginal costing profit is 318,000. Excuse me. We know that it is 318,000, the marginal costing profit. Okay. Now, using this only, we have to do something and get the absorption costing profit. So how do we do that? You have to know that the difference between marginal costing profit and absorption costing profit is the change in inventory multiplied by the fixed production overhead per unit. So basically like a OAR. Okay, the OAR. Now, the change in inventory, how you get that figure is, you will have to compare the opening inventory and the closing inventory. That's a change in inventory. So, in this question, we did not have a change in inventory. I mean, we didn't have an opening inventory. It was 0. We only had a closing inventory as 1,000. So, the difference between opening and closing is just going to be 1,000. That's a change in inventory. Now, we have to figure out a way to get the OAR. We don't have labor hour details. But what do we have? We have the units. So we can just make use of the units. So how will we calculate OAR in this case? That will be the 143,000 divided by the budgeted units, which is 26,000. Okay. So the OAR will be, how 143,000 divided by 26,000, which is 5.5. Okay. So 1,000, you multiply it by 5.5 and you will get the difference between marginal costing profit and absorption costing profit, which is 5,500. Now the question is this: we know that the difference between marginal costing profit and absorption costing profit will be 5,500. But it can be either 318,000 plus 5,500, which is 323,500, or it can even be 318,000 minus 5,500, 312,500. Both these answers will give you a difference of 5,500 only. So we have to figure out, is it higher? Is absorption costing profit higher, or is it going to be lower? Okay. So for that, there is another theory that you should know. Okay. That is, if inventory increases, then absorption gives a higher profit. If inventory decreases, then marginal gives a higher profit. Okay. Now, in this situation, what has happened? The inventory, if you remember, there was no opening inventory. It was 0. From 0, it increased to 1,000 because we had a closing inventory. So, inventory has increased. That means absorption should give the higher profit. So, here it has to be 323,500 because then absorption will be higher, marginal will be lower. If you choose 312,500, then marginal will be higher. So, this can't be the answer. The answer is 323,500, which is C. Very common question, okay, where they tend to always ask about how to convert from marginal to absorption. For some reason, I don't know why, they always like to, ask you to convert. 323,500. So for 22.11, the answer is C. And for 22.10, the answer is 318,000, which is B. Okay. Okay. So once you're done copying this, take a break, and then we will come back and finish off the rest of the questions. Okay, so it's 7:10 now. Please be back at about 7:25. Okay, 7:25, 7:30. Be back, and then we can continue with the rest of the questions. Okay. Hope you guys are back. Let's start, okay? So 22.12. Now, before I read the question itself, when I see this, the format in which the question is given, there are 2 units and $2. It should immediately strike me that this has probably something to do with high-low method. Because only in the high-low method will we need information in this, format. So keeping that in mind, let's read what it says. It says, the cost of the factory maintenance department for Freer company appear to have a variable element dependent upon the number of units produced. Okay. The fixed element of the cost steps up by 30,000 when 32,000 or more units are produced. The variable cost per unit is constant. Volume of production, if you produce 28,000 units, then the cost is 160,000. And if you produce 34,000 units, then the cost is 208,000. The question is, what would be the total cost for 29,000 units and the total cost for 35,000 units? Now, the problem with this question is that there is a step up. Okay. And where is the step up happening? It's happening when we produce 32,000 units or more. So 28,000 units, this 160,000, it doesn't have the step up of 30,000. Whereas the 208,000, it has the step up. Okay. Now, first thing is we have to know that if we want total cost, we have to know the variable cost and the fixed cost. First thing. So to know variable cost and fixed cost, you have to do high-low method. To do high-low method, you need 2 points. That is also there. But the problem is one is without a step up and one is with. So what we'll do is we will deduct the step up from this 208,000 and make both the figures, be on the same, basically the same line, so both don't have the step up when we are doing the high-low method. Okay. So how will the high-low method look like? Usually it's like this. We have activity and we have cost. Then we have the high and the low. Okay. So highest activity is 34,000 and low is 28,000. The associated cost at 34,000, the cost was 208,000. But we are going to deduct the step up because we want both of them to be without step up. So 208 minus the step up they're saying is 30,000. So that is 178,000. And at 28,000, the cost is 160,000. Okay. Now we need to get differences. So the difference is basically 34,000 minus 28,000. And here 178 minus 160, which is 18,000. Okay. Now, the next step in the high-low method is to get the variable cost per unit. How do we do that? We take the cost figure, which is 18,000, and we divide it by the difference in activity. So we take the difference in cost, which is 18,000, divided by the difference in activity, which is 6,000. That will give you an answer. This divided by this. 3. Okay. So the variable cost per unit is $3. Okay. Now let's get the fixed cost. Now to get the fixed cost, you have to use an equation like this. Total cost equals fixed cost plus variable cost per unit into the output or the number of units. Okay. Now we have to substitute either the high or the low. Let me substitute the high's information. Okay. Right. So when you're doing the substitution, actually let me substitute to the low, okay, because high has the step up now. So in this case, it will be more reasonable to substitute the low. Right. So total cost in the low is 160,000. It should equal to the fixed cost. That's what we're trying to find out. Plus the variable cost per unit, we know it's 3 and the number of units at the low was 28,000. Okay. Now, like I told you, when you have a situation like this, directly put it in your calc. Fixed cost will be X. So 160,000 alpha calc fixed cost, we can just call it alpha x plus variable cost is 3 multiplied by 28,000. Close brackets, shift calc. So it will solve the equation. Fixed cost is 76,000. But remember, this is without the step up. Without the step up. Now we have the variable cost and the fixed cost. Now let's answer the question. They are asking you total cost for 29,000 units. So total cost. First, let's do for 29,000. Total cost equals fixed cost plus variable cost per unit into output. That's the equation. So we have the fixed cost at 29,000. It's less than 32,000, right? So there won't be a step up. So the fixed cost will just be 76,000 plus the variable cost per unit is 3 multiplied by output we're talking about is 29,000. Okay. So I'll get the answer here, 76,000 plus 3 times 29,000. Okay. So at 29,000, the total cost is going to be 163,000. Okay, it's going to be 163,000. So I'll write it here as well. Total cost. Now, same thing you have to do for 35,000 units. So let me copy these equations over here. Now, we are not talking about 29,000. We are talking about 32,000. Now, at 32,000, the fixed cost is going to be 76,000 plus now the step up will happen. So it will be 76,000 plus the 30,000. Okay, so remember that. Okay, then plus the variable cost is 3 and the output is 32,000. So now you can get an answer 76,000 plus 30,000 plus 3 times, which is 202,000. Let me just check because there are two additions now. 30,000, 3 into 32,000. Just give me a second. Sorry, they are asking the total cost for 35,000 units. Okay, 35,000 units, not 32. So small error there. This is 35. Okay, so this will be 3 times 35,000. Let me just check. Yeah, okay. So then this will, I'll just change this as well. 3 times 35,000. Sorry. So the total cost is 211,000. Okay, sorry, 32,000 is where the step up happens, but they're not asking for 32,000, they're asking for 35,000. So instead of 32 in the output, I put 35. So that will give you 211,000. So that's the total cost. Okay. So at 29,000, the total cost will be 163, and at 35,000, it will be 211,000. The answer is going to be B. Okay, the answer will be B. So that's how you would do the high-low method if there is a step up. Okay. You can take this down if you want. It starts off from this point onwards. If you're confused how that 178 came, it is 208,000 minus the 30,000 step up. All right. So hope you've taken this down. Let's move to the next one. So this is all about labor variances. Okay. So I hope again, you know the equations, you're comfortable with it. So take your time and see if you can arrive at the answer. They're asking you, they've given you all the information that you need. They're asking you for a labor rate variance and a labor efficiency variance. Okay, try it out. I'll give you 5 minutes. If you have the equations, if you know the equations, this will be just a walk in the park. It's easy. Everything is given. If you have questions, you can ask. I just want to give you a chance to do this. Because it's nothing, some variance questions, it won't be direct. I mean, it will be a little asking you to work backwards and stuff, but this one is very direct. Okay, so that's why I want to give you a chance to try it out. Okay, so in case you're stuck, I will start off with typing the equations, okay? Okay, so these are the equations that you need to use to calculate the labor variances. Actual hours into actual price, actual hours into standard price, standard hours for actual production into standard price. Okay. Now, let me read through the question, and while I'm reading it itself, I'll put in the figures into the equations. So it says here, Ryan Company is operating a standard costing system, has the following direct labor standards per unit for one of its products. Okay, so the standard is 4 hours at 12.5 per hour. Okay, so 4 hours at 12.5 per hour is the standard. Last month, when 2,195 units of the product were manufactured, the actual direct labor cost for the 9,200 hours worked was 110,750. Now let's see. Do we have actual hours? They're saying actual direct labor cost for the 9,200 hours. So we know that actual hours is 9,200. Are we given the rate, per hour rate? Actual rate is not given, but they're telling us that the total that we paid was 110,750. Okay, so if we want, we can find the rate. That will be 110,750 divided by 9,200, which is 12.03. Okay, so if you want, you can just put it as 12 here. Okay, then again, they're asking for actual hours. We know it's 9,200 into the standard price. Standard price, if you look at the beginning itself, they say these are the standards, 4 hours at 12.5 per hour. So standard price is going to be 12.5. So 9,200 into 12.5, it's going to be 15, wait a minute, 9,200 into 12.5. Yeah, 115,000. Okay. Finally, standard hours for actual production. So actual production 95 units. Standard hours we are allowed is 4. Okay, so 2,195 into 4 into the standard price is 12.5. Let me just copy these two and bring it down. So everything will be in the same line. Okay, so 2,195 multiplied by 4 multiplied by 12.5. So that is 109,750. Okay, so now we just need to get the differences. The difference over here will give you what we call the rate variance, and the difference here will give you the efficiency variance. Okay, right. So first let's just get the difference, then we'll decide whether this is adverse or favorable. Okay, so first let's get the difference. 4,250, and here the difference is 5,250. Right, so let's decide if this is adverse or favorable. Okay, so 4,250, if you look, it's between these two boxes, the first and the second. Okay, the first has entirely actual data, the second has a little bit of standard. So this is the budgeted figure, 115,000. Has a little bit of standard, no? So I have budgeted to spend 115,000, but actually I have spent 110,750. I have spent less. If I spend less, that's a good thing. So this will be a favorable variance. Okay, I'll just write it here. Favorable. 4,250, favorable. Then over here, the third box versus the second box. Third is entirely budgeted data. Second box has a little bit of actual. So this is actual figure. This is the budgeted figure. I budgeted to spend 109,000. I have spent more. I have spent 115,000. Spending more is always a bad thing. So this will be an adverse variance. So rate is 4,250 favorable, which is A, and efficiency is 5,250 adverse, which is D. Okay. Oops. So that will be A and D. 22.13 is going to be A and 22.14 will be D. Like I told you, if you know the equations for variances, that's all you need for questions. Okay. Right. Let's look at 22.15. It's saying the purchase price of an item of inventory is 110 per unit. In each 6-month period, the usage of the item is 50,000 units. In each 6-month period, the usage is 50,000. The annual holding cost associated with 1 unit equals to 3% of its purchase price. The cost of placing an order for the item is $15. What is the EOQ to the nearest whole unit? EOQ formula. It's given to you. So I'll just display that. This is your formula sheet. And the EOQ formula is this. Okay, so let me just copy this. This is the EOQ formula. So what are the things you need? First, you need the cost of ordering. Then you need the demand, but this is the annual demand. Okay, so I'll say annual demand. Then you need the cost of holding. If you have these three figures, you will be able to calculate EOQ. So do they give it to us? Cost of ordering. Let's see. They're saying the annual holding cost associated with one unit equals to 3% of purchase price. So let's put the holding cost first. That's 3% of the purchase price. What's the purchase price? They're saying purchase price is 110. So 3% of 110, 3.3 is the cost of holding. Then they're saying the cost of placing an order for the item is 15. So cost of ordering is 15. Fine. Now we need only annual demand. So they're saying here, in each 6-month period, the usage of the item is 50,000. So if we need annual demand, you have to take the 50,000 and multiply it by 2 because it's a 6-monthly demand. So you have to be careful there. So that is going to be 50,000 into 2, obviously 100,000. Okay, always in the EOQ formula, 90% of questions, they will not give the annual demand. They'll give monthly demand, a daily demand, or they might give like this a 6-monthly demand, a quarterly demand. So most of the time, the demand figure, you might have to convert it to annual demand. Sometimes they give annual also, but that's what I'm saying. 90% of the time, you will have to do something to the demand figure. So let's put this in the cal. Let's put the root sign first, open brackets. 2 times the cost of ordering, which is 2 into 15 into the demand, which is 100,000, over the cost of holding, which is 3.3. 953. So the EOQ is 953. The answer is B. Okay. That's a straightforward question. You don't even have to know the formula. It's given to you in the exam. But normally, when you do a lot of questions before the exam, this formula will just stick to your head. Okay. Right. Now let's look at the next one. This is also to do with the high-low method. How do I know that? When I look at it, the way the question is put, I know that it has something to do with high-low method. But again, if I read it, let me read it for you and we'll see it's not very direct. Just look at it. It says, the cost of the factory maintenance department for C company appear to have a variable element dependent upon the number of units produced. The fixed element of the cost steps up when 20,000 or more units are produced. At an activity level of 22,000, the fixed element of the cost is 25,000. So it's not a normal high-low method. They're saying when we go above 20,000, there is a step up. Okay. And they're saying at 22,000, the fixed cost is 25,000. When the activity level is 20,000, the fixed element is 25,000 total, not just the step up. Total fixed cost is 25,000. Then they're saying the variable cost per unit is constant. Thereafter, it's the normal units, the dollars. What would be the total cost for 19,000 and the total cost for 21,000? I'll give you 5 minutes. See if you can figure it out. It's not the same as what we did because earlier they gave us the step up figure. Here they are not giving us the step up figure. They are telling you the stepped up fixed cost, full fixed cost. What do you think you can do? I'll just tell you, you can't use the normal way. Because if you're doing it the normal way, you should have the step up figure. Here they are not giving you that. So we can't, because we can't use these two numbers, because 18,200, the 18,000 units and $200,000, this is without step up, and this 245 is with step up. Okay, so we can't just deduct, 25,000 from this and carry on, because if you deduct 25,000, you're not just deducting the step up, you're deducting the entire fixed cost. So that's also wrong. So you have to use a little bit of your general knowledge and see if there is another way for you to do this sum. So usually, if you're doing the high-low method, I hope you got it, guys, but I'll just show you what you usually do. Activity will have cost, then we can put high, and we put low here, and then what do? We take the highest activity, which is 22,000, 18,000, 245,000, and 200,000. Okay. Now the problem is, when you're doing it this way, these two costs, they have to, match with each other. Either they have to be without step up or they have to be with step up. Because if you remember, if you had like about 6 numbers or even 3 numbers, we say use 2 figures either before step up or after step up. Or even if you have 2 figures like this and you know how much the step up is, then like in the previous question we did today, you can deduct the step up from the total cost. But here we don't have that option as well, because we don't know the step up figure. Okay, so now you are helpless. You can't use this at all. We have to figure out another way. So one thing we know is at 22,000 units, the fixed element is 25,000. Okay, the fixed cost element, usually we only find it in step 3 or 4. Step 3 of the high-low method. Here, they are giving us the answer. That is unusual, right? So let's try to work with that. We know of an equation like this: total cost equals fixed cost plus variable cost per unit into output. Okay, we know of this equation. Now, at 22,000. Let's see if we have at least the total cost we have it. It's 245,000. So let's put that. 245,000 should equal to the fixed cost, should equal to fixed cost. Fixed cost we know is already 25,000 minus the variable cost per unit, we don't have it, multiplied by output we know 22,000 units. Okay, so we can put 22,000 here. Now we have an equation. We have one unknown variable, the variable cost per unit. We can use our cal, rearrange the equation and get the variable cost per unit figure. Okay, so that's what we're going to do now. 245,000 should equal to 25,000 minus, open brackets, variable cost per unit is X, into 22,000. Close brackets. Shift, calc, solve for X. And it's saying that the variable cost per unit is 10. Okay, the variable cost per unit, wait, you know why it's saying negative? Because I have said fixed cost minus variable cost. It's actually plus, right? Fixed cost plus variable cost. Here also, 25,000 plus. Okay, so I can change this a little. 25,000 plus. Calc, so now it will be positive. Okay, so variable cost per unit is 10. Okay, we know that. Now variable cost per unit, it's 10. Now they are asking you what would be the total cost for 19,000 units. Okay, think about it. How do you think you can go? I'll give you about 2 minutes. Think about how can you get 19,000. Because now what do we know? I'll tell you what we know. We know the fixed cost after step up. How much is that? 25,000. We have the variable cost per unit, both before and after, it's the same, which is 10. Now, if you want to know the total cost of 19,000 units, 19,000 is before step up. So we can't use this 25,000 and add the variable cost per unit into output because 25,000 is after step up. Okay. So what you have to do is, using this variable cost per unit and this same equation, you should try to get the fixed cost at 19,000 units. Okay, so let's see what information we have. We don't have for 19,000, but we have 18,000. 18,000 is also before step up. At 18,000, total cost was how much? 200,000. That should equal to the fixed cost, which is what we are trying to find out, plus the variable cost we know is 10. The output is 18,000. Now we are trying to get the fixed cost before step up. Okay, that will be 200,000 alpha equal sign. The fixed cost, let's call it X, alpha X plus 10 into 18,000. Close brackets. Shift, calc, solve for X, 20,000. Okay, so now we know that the fixed cost before step up is how much? 20,000. Okay, so after step up is 25,000, before step up is 20,000. So the step up is actually 5,000. Okay, now we have all the information that we need to get total cost for 19,000 units. So total cost for 19,000, use the same equation. So we are trying to find the total cost. So what we do, we take the fixed cost. 19,000 means it's before 22,000, right? So it's before the step up. Fixed cost is 20,000 plus the variable cost is 10 into the output is 19,000. Okay, so 20,000 plus 10 into 19,000, that will give you 210,000. Cost that 19,000. Same thing, total cost for 21,000. Okay, for 21,000, same equation. Copy this, paste it here. Fixed cost. Now at 21,000, let's see, at an activity level of 22,000, the fixed element is 25. Okay, when does the step up happen? They say it happens at 20,000. Okay, so that is 21 means we are talking about after 20,000. So the step up has happened. So the fixed cost is not going to be 20, it will be 25. Okay, so 25,000 plus variable cost is 10 and the output is 21,000. So that will give you 235,000. Okay, so the total cost for 19,000 is 210,000 and the total cost for 21,000 is 235,000. So the answer is B. Is it? No, wait. 210 and 235. So that's A. Okay. So this is a little, it's a little different. Now in your exam, when you see this, definitely this is not part of the syllabus necessarily. This is not how we do high-low method usually. But based on what, when you see something different, first of all, understand what is the new thing they have given. Because most of the time, you will have to work with that figure. So here, the new thing that they gave is they directly gave you the fixed cost. So from there, you have to use your common sense and see what can I work from that point onwards. Okay. So I know this is not something that unless you have done it in the past. Now since you have seen this question, even if a similar question comes, you will understand. But if at your exam, this is the first time you're seeing this, spend about 2 minutes trying to figure it out. But if it's not making sense to you, by all means, leave this and go to the next question. Okay. Now don't think, okay, high-low method, I did it, I know it. Okay, something is wrong. Don't think like that. Okay, there's something tricky in this. See if you can figure out what it is. Spend about 2 minutes. That's what I'm saying. 2 to 3 minutes max. If you can't, then leave it because anyway, you're only going to get 2 marks for this. Just because you are smart and you figured it out doesn't mean they're going to give you 6 marks. Okay, so more than anything, keep an eye on the time. Okay, everything comes secondary to time only in your paper. Okay, right. 23.2. Wall company has a capital employed of 300,000. It has a cost of capital of 10% per year. Its residual income is 30. What is the company's return on investment? Okay, again, a very common question where they give you the residual income and ask for return on investment. Or they will give you the return on investment and ask for residual income. So if you don't know the two equations, definitely you're going to get stuck. Okay, so let me just type the equations here first. Residual income equals to the controllable profit minus the controllable investment into the cost of capital. That is residual income. And how do we calculate the return on investment? You should know these equations, guys. That is basically, one second. Yeah, return on investment. No, so that will be the controllable profit divided by the controllable investment and that into 100. Okay. So what you have to understand here is that there are some common figures, controllable profit and controllable investment. Okay. So see how the two equations can connect with each other. Okay. So it's saying here, they have a residual income of 30,000. That's the residual income. Okay. So equals to, the residual should equal to, the RI should equal to the controllable profit, which is how much? We don't know. So let's just type it as controllable profit. Minus the controllable investment do we have? They're saying capital employed. So that is the investment 300,000. Into the cost of capital is 10%. That's also given. Now again, you can see that there is an equation with only one variable that you don't have. Again, don't waste time rearranging anything, right? Just put it as it is. 30,000 alpha equal sign. Controllable profit means alpha x minus the investment or the capital employed, which is 300,000 into 10%. Shift and the open bracket sign will give you the percentage, close brackets, and then press shift calc. It says solve for x, press the equal sign. Okay. So now we know that the controllable profit, that was only x, no? Controllable profit equals to 60,000. Now what are they asking for? ROI, no? So we have calculated controllable profit, 60,000 divided by controllable investment. That is again the capital employed, which is 300,000. Okay, that figure you multiply it by 100 to give it as a percentage. Okay, so show this as well, 60,000. Sorry, 60,000 over 300,000 into 100. That is 20%. So if you have the RI and either the profit or the investment, one of these figures, if you have it, then you can easily find the ROI from that figure. Okay, so the answer will be 20%. By the way, these equations are not given at your exam. Okay, you have to memorize them. Okay, quickly take it down if you don't have the equations. Okay, so let's move on. It says here, are the following statements which refer to documents used in material procurement procedures of a company true or false? Okay, so these are to do with the documents that you have to raise when basically if you know you're in a production department and you want material for production. So how do we make people buy that material for you? So I think, if I'm not mistaken, either TRG 1 or 2, I went into this in detail. Okay, I went into this in detail where I showed you all the different documents that have to be raised. So in case you're not sure, it will be either class 1 or class 2, most probably class 1. Okay, so if you're not sure with what I'm talking about now, just have a quick look at that. Okay, so let me check. Let me read this. All purchase requisitions are prepared in the purchasing department and are then sent out to suppliers. Purchase requisitions are not prepared in the purchasing department. They're usually prepared in the production department. Okay. So, I'm sorry, the purchase, let me come again. Purchase requisitions are not prepared in the purchasing department. It is started off in the production department. So what happens? Production, they raise something called a materials requisition. They send it to the stores. If the stores doesn't have the material, then the stores will raise the purchase requisition. Okay, so the first one is false. All goods received notes are prepared in the goods inwards department. So good inwards means like the stores. So good received note, the stores only will prepare it. Once they get the goods, the delivery, they will check if everything is proper and they will release a goods received note. So statement 1 is false and statement 2 is true. Answer will be D. All right. Then it says, Hacked company uses standard marginal costing. Last month, the standard contribution on actual sales was 40,000 and the following variances arose. So we had sales price, sales volume contribution variance, fixed overhead expenditure. There were no variable cost variances last month. What was the actual contribution for last month? Okay. So when you see this kind of a question, you have to understand that this has nothing to do with the equations, but it has something to do with the reconciliation statement. Okay. So think about it, marginal costing reconciliation statement. So let me go to my variance summary that I shared with all of you. Give me a second. Okay, sorry. This is the summary. So they're talking about marginal costing and they want a figure for actual contribution. So we need to go to the reconciliation statements. These two are absorption costing, so just keep it. We're talking about marginal costing. And if we want actual contribution, then we have to follow this statement, this particular statement, okay? So let me copy this and bring it to my Excel sheet. Okay, so the numbers are different, obviously. We just need the format, okay? Right. What do we have? So it's saying the sales price is 1000 favorable. So this sales price figure over here is 1000 favorable, it seems. So let me just maybe insert let's see if I can put a text box. Okay, over here, sales price. To change the figure, it is 1000 favorable. Sorry, okay, I have to change the figures here. 1000 favorable. Then it's saying the sales volume contribution variance. So what is that sales volume contribution margin? This figure, that is 3500 adverse. So at this point, I'm just putting in all the figures in. How much is that? 3500 adverse. Bear with me. I'll clean this up for you. Okay, it will make more sense in a bit. Fixed overhead expenditure variance. So where is the fixed overhead expenditure? Usually we put it over here. Fixed overhead expenditure variance, that is 2000 adverse. So I'll bring another text box here. This will be 2000 adverse. And finally, they're saying there are no variable cost variances last month. So this entire thing, direct material, direct labor, variable overheads, everything is not required. So let me just, cover it for you. So all of this is not, sorry. All of this is not going to be there. Okay. Right. So let's just see what we have right now. Let's clean the other information that we don't need as well. I think it would have been faster if I typed it. Sorry, guys. Okay, so this figure we don't have. So let me just make it blank. This figure also we don't have. This 1000, 100 and 1000 is another question. And this total we don't have. What else don't we have? This figure is not there. This is not there. None of these are there. Okay. Now what do we have? We just have the fixed overhead expenditure. We have the sales price. We have the sales volume contribution margin. Okay. These are the only figures that we have. Now the question is asking us for the contribution. Okay. Now contribution is this answer. Actual contribution, this answer. Okay. How do you think you can get this answer? Standard contribution, one more figure we haven't mentioned. Standard contribution on actual sales, 40,000, this figure. This is 40,000, it seems. So we have a total also. So what you have to understand is, this 40,000 is a total, meaning it's going to be budgeted contribution plus or minus the sales volume contribution margin. So we don't have to know all of this, but what we know is the standard contribution on actual sales is 40,000. And then what do we know? We know that this price variance is 1,000 favorable. So if you want to arrive at the actual contribution, all you need, it's very simple, although it took so long, take 40,000, add 1,000 because it's a favorable variance, 40,000 plus 1,000, 41,000. That is the actual contribution. So that's D. But you wouldn't know that that is the case. You wouldn't know that you have to only add the sales price if you didn't know about the structure of the reconciliation statement. Okay, I hope you understand that. If you didn't know that, under the standard contribution and actual sales, you will get the sales price, and after that, you will get all the normal cost variances, and finally, you get actual contribution. If you didn't know that, you won't be able to figure out how to get that contribution figure. Okay, that's why it's important. When it comes to variances, two things are important. One is you should know the equations. Second is you should know the structure of the reconciliation statement. Both are equally important. Okay. You can take this down. Sorry. Sorry, guys. Okay, so we're almost there. Just a few more questions and we can wrap up this TRG. Okay. So if you have been following this from the beginning, let me tell you exactly how many questions we have covered. We have covered exactly 87 questions. Okay, 87 plus everything to do with variances have been covered. Okay, so 87 MCQs from all over the syllabus plus an entire TRG, which is TRG 3, the third week, an entire TRG dedicated just to variance analysis. Okay, if you can do all of these questions, guys, I'm telling you, you should be definitely in a good position to sit for this paper and finish it off. Don't waste your time, okay? Because it's MA, I told you, you also have a life to live, okay? You can't keep on studying because you will never be 100% confident. The thing is, if you were doing another paper that had a session like March, June, September, December, then what happens is once you pay for the exam. Now March exam means you have paid in January. So in January, you pay it with the, with confidence that you have another month, you can somehow study. But what happens is, anyway, after payment, there is no going back. Okay, so you somehow make it work. In that 1 month, you will do something and make it work. With MA, the problem is since you decide on the date, you tend to keep on putting it, just keep on postponing the date. So don't do that. That's what I'm trying to say. Because it won't give you peace of mind. Finish it off if you're comfortable with everything. Okay? Right. Let's look at 23.5. It says, MB company uses flexed budgets. 1 second, let me zoom this a bit. Okay, MG company uses flexed budgets The fixed budget for last month was based on 100% activity and it showed direct costs of 100,000. Okay. Last month's actual direct costs were compared with the flexed budget to show the following. So actual was 93,600 and the variance was 2,400 adverse. What was the actual activity as a percentage of the fixed budget last month? Okay. So first, let's see what is the amount that was in the flexed budget. Okay. So actual was 93,600. Flexed budget is 2,400, right? So what happens? 2,400 adverse means you have to deduct the 2,400. So that is 93,600 minus 2,400, which is 91,200. Okay. So what I'm trying to say is, now the actual is 93,600, but 2,400 adverse means, I'll type it like this, it will make more sense. Actual flexed. Okay. Actual is 93,600. Okay. And the flexed, they are saying, now think about it. If it was 2,400 adverse, then the actual should have been 91,200. It should have been 91,200, but it has become 93,600. That's why we are saying the difference 2,400 adverse, because we have actually spent 2,400 more. So what the actual should have been, that is what we call the flexed budget. Okay. I'm repeating. We know that the actual direct cost is 93,600 and the variance they're telling is 2,400 adverse. That means we have spent more than what we budgeted. So what is the budget? 93,600 minus 2,400. So we budgeted 91,200. That's the flexed budget. Now the question is asking you, what is the actual activity level? So if we were at 100% activity, the question is telling us that the direct cost will be 100,000. But now what has happened? The cost has become 91,200. Then what do you think the percentage will be? 91.2%, straightforward. Okay. But catch is you shouldn't use the 93,600 because 93,600 is, it's not the figure that we predicted. Okay. That for some reason it increased. So we can't compare the actual and the fixed. You have to compare the flexed and the fixed. Okay, so 91,200, you compare it with 100,000. So that will be 91.2%, which is A. Okay. Then we have another process costing. Okay, let's quickly do that. 23.6. Okay, so I'll just give you a minute since we have time. I'll give you a minute, see if you can figure it out. So with process costing, what's important is always follow that structure. Okay. So they're talking about liters. So let's have a column for liters and a column for the monetary value, the dollars. Okay. What are they saying? A process operates with a normal loss of 5%. All losses have a realizable value of 38 per liter. Okay. That's the scrap. Last month, 10,000 liters were input. So let's put the input 10,000. Input to the process, and the good production was 9,200. Process costs arising last month were 456,000. So the cost is 456,000. There was no work in progress. What was the credit entry in the process account for abnormal loss? So they're asking the valuation for abnormal loss. So first, let's figure out what the normal loss was. They're saying normal loss is how many percent? 5% of input. 5% into the input, which is 10,000. Normal loss is 500. And this normal loss, they're saying all losses have a realizable value of 38. So the scrap is 38. So the 500 liters, you can sell it at $38. So 500 into 38, you will get 19,000. You will get 19,000 as an income. Okay, because you are selling, I'll write it here, 500 into 38. Okay. Then we can find the totals over here. 10,000 minus 500. It's a loss now, so 9,500. This is the expected output. Okay. And here 19,000 is an income, but we will deduct it from 456,000 because an income will reduce a cost. A cost 456,000 is a cost. So this minus 19,000, which is 437,000. Okay, 437,000. Now, let's figure out what the actual output was. They're saying the actual good output production was 9,200 only. So we expected 9,500. We have only got 9,200. So the difference, we have lost more actually. That is the abnormal loss. What is that? 9,500 minus 9,200, which is 300. 300 liters. But they want to know what is the monetary figure. What is the dollar figure for this 300? Now remember this. Abnormal losses are always valued at the full cost per unit. So what is the cost per unit? Let's calculate it. Okay. That will be this figure, 437,000 divided by 9,500, which is 46. Okay. So this abnormal loss of 300, you have to multiply it by 46, and that will give you the valuation of the abnormal loss. So that is 300 times 46, which is 13,800. So the value of the abnormal loss that you have to credit in the process account is 13,800, which is C. Okay, C. Right. Let's go to the next one. The price index for a commodity in the current year is 175,000. So the price index current year 175, base year is 100. The current price of the commodity is 92.7 per unit. What was the price per unit in the base year? Okay, so we did a similar question like this today. What do? We take the current price, 92.7, multiply it by the base year's price index, which was 100, and divided by the current year's price index, which is 175. So that will give you the answer. How much will it be? 52.97. Okay, so the answer is C. Right. D company. This is 23.8. D company uses a pie chart to show its sales for its various products. One of the segments on the pie chart is 120 degrees, and this represents 200,000 worth of sales of the product D. What is the total sales value for D company? Again, how do you get the degrees usually? You will take the 200,000, the sales of that particular product D, you will divide it by the total sales. You will divide it by total sales, not just product D, all the sales. And that answer, you will multiply it by 360 degrees. That's what we do. Okay, then you will get an answer for the degrees that, you have to use in the pie chart. But here, what are they doing? They're giving us that answer as well, 120. But again, you can see that this is an equation where only one figure is unknown, the total sales. So again, you can directly use your cal like I taught you all this while. Press the fraction sign, 200,000 over total sales is alpha x into 360. Alpha equal sign, it should equal to 120. Now, if you press shift and calc, it will solve the equation for you. And you'll know that the total sales should be 600,000. Okay, so let me copy this. Total sales equals to 600,000. And you see, it's easy. Okay, so don't ever waste time trying to rearrange, right? If you rearrange, you know how this will look like. Okay, you know how this will look like. it will be 120 divided by 360. Okay, then you will have to multiply both sides by the total sales. So it will ultimately be 200,000 over 120 divided by 360. Okay, so that's how it will be. If you're not comfortable with a cal, then by all means go ahead and rearrange, but it will take a lot of time, unnecessary time. Okay, so instead of that, just directly use your cal and get the total sales figure. It will be 600,000, which is C. Okay. Okay, then it's saying D company forecasts costs using the model y equals a plus bx. Okay, so we use the model y equals a plus bx. The gradient is 40. When y is 1100, then x is 20. What is the value of the intercept? Okay, so again, I have told you this is y equals a plus bx. What are the figures they have given me? They have told me that the gradient, so b is 40. Then they are saying y is 1100, x is 20. They are asking for a, the intercept. Okay. So let's put in the figures that we know already. Y is 1100. It should equal to a is what we need plus, open a bracket, b is 40 multiplied by x, which is 20. Okay. So now all you have to do is just put this also in your cal. So that's 1100 alpha equal sign alpha x plus 40 into 20. Close the bracket. Shift calc solve. So that will be a equals 300. A is 300. So the answer is also A. Okay. One more thing before this is the last question. Before I move to that, I have a feeling some of you might have a problem rearranging this. So I'll just show that as well. Okay. In case you don't have a cal where you can, put the figures directly. I'll just quickly show that. Because here the denominator is total sales. So how this works is like this. You will have the equal sign 120, and then what, this is multiplied by 360. No, so you can divide this by 360. Okay, so that will give you an answer, what, 120 divided by 360, which is 0.3333, something like that. Okay, then what you do, this 360 won't be there anymore. Okay, I'll just, that we divided it, so it's gone. So you multiply this side by total sales. So this and this will cancel. And you multiply this side also by total sales. Okay, so the equation will look like this. 200,000 will equal to, okay, it will equal to 0.333 into the total sales. So then what do? You have to divide both sides by 0.333. Okay, so underline this and divide both sides by 345. Okay, and this also you can do the same. Okay, and then the total sales, let's see if the answer is coming, divided by 120 over 360. That's how I got it now. So you will get that 600,000. Okay, so that's how you rearrange. I'm sure you're good at it, right? You do this what in grade 6 maths or something. Okay, so 200,000 divide. Now, if you put it directly, let me check that also. Yeah, you might get 600,006. That's because this 333, it's a recurring figure, right? It will keep on happening. If you put it in your cal, let me show that as well. If you put 120 divided by 360 in your cal, you can see the answer will be like this, 1/3. No, so it will be 0.333. It will keep on, the entire line will be threes. Okay, so that's why when you're just using with 5 threes, you will only get 600,006. But if you want a very accurate figure, then how you should put it in the cal is like this. Open your fraction, 200,000. over, open a bracket again, 120 divided by 360. So if you put it like this, then you will get the 600,000 accurate figure. Okay, so this is how you will rearrange. Right, so let's move on to the last question for this session, February's TRG. It says B company has under-absorbed fixed production overheads for the period by 9,000. The fixed production overhead absorption rate was 7 per unit. So the OAR was 7 and is based on the normal level of activity of 5,000 units. Actual production was 5,500. What was the actual fixed production overheads incurred for the period? Okay, I think we last spoke about this last week. So what you have to understand is, when it comes to absorption costing, there is always this under-absorption or over-absorption problem. What is that? We incur an actual overhead, regardless of what our budget is. We don't know what our budget is. But after everything happens, at the end of the month, we will have a figure that we really incurred for overheads. That's your rent, your electricity, your security guard salary, admin lady's salary. All of that, we will add it up together. And we will get a figure called actual overheads. Okay. And there will be another figure called absorbed overheads, meaning before that month was over, when we used our budget, how much did we absorb as overheads into our cost unit? That is the absorbed overhead. Now, absorbed overhead, there is a way to calculate it. It's the OAR multiplied by the actual. In this case, they are giving us units, right? So it can be units or actual hours or something. But now OAR means it will be overheads divided by an appropriate base now. So whatever that base is, that actual figure, you will multiply it with the OAR. Okay, so in this case, we are talking about units, so actual units. Now, when you compare these two figures, you will get whether it is an under-absorption or whether it is an over-absorption. Okay, now in this question, they are telling you there is an under-absorption of 9,000. Okay, they are telling you that there is an under-absorption of 9,000. Then they are saying the fixed production overhead absorption rate was 7. This OAR is 7, it seems. And it's based on the normal level of activity of 5,000. Now, don't get confused there, guys, because I'll tell you properly how to calculate this absorbed overhead. So, it's the OAR multiplied by actual units that you produce. Okay, now think about it. OAR, you calculate how? It is the budgeted production overheads divided by a total appropriate base. So it can be labor hours, machine hours, anything. But this total appropriate base is also a budgeted figure. Okay, so remember, when you're calculating OAR, you never use actual figures. You only use budgeted figures. So that's why they're saying this 7 per unit is based on the normal level of activity, which is 5,000. That's the budget. Okay, so OAR, we have got it as 7. So that's no problem there, 7. But to get absorbed overheads, we have to multiply the OAR with the actual units. So actual units, what are they saying? It was 5,500. Okay, so careful. Absorbed overheads, it's the OAR multiplied by the actual units. Now, suppose this appropriate base was not units, it was labor hours, then it will be OAR multiplied by actual labor hours. Okay, but the key is OAR is a figure based entirely on budgets. Absorbed overheads has a bit of both. It has the OAR, which is budget, multiplied by the actual units or labor hours or machine hours or whatever you're using. So 7 into 5,500 will give you the absorbed overhead. So 7 into 5,500. So the absorbed overhead is 38,500. Now the question is asking you, what is the actual fixed production overhead? They're asking this answer. Now what you have to know is the difference between these two. That is the actual overhead and absorbed overhead. That is only this 9,000. But we don't know if the actual overhead is 9,000 more than 38,500 or 9,000 less. So let's just put both the options. 38,500 plus it can be 9,000. Then also the difference is 9,000. Or it can be 38,500 minus 9,000. It can be 29,500. Now we have to decide based on whether it's an under-absorption or over-absorption. Here it's under-absorption. That means I am supposed to absorb a particular amount. Supposed to absorb means the real figure, actual figure that I should have absorbed is over here, the actual overheads. But I have absorbed less. In my books, I have absorbed 38,500, and that 38,500 is actually less than the actual overhead that I incurred. So I have absorbed less. If I absorb less only, it will be called an under-absorption. Okay, so that means the absorbed overhead figure, it has to be less than the actual overhead figure. So it can't be 29,500. It has to be 47,500. So when would it be 29,500? Suppose it was not an under-absorption. If they say this was an over-absorption, just saying. Okay, then I should have absorbed some amount, but I have absorbed more. That means the actual overhead is less. In that case, the answer would have been 29,500. Okay, but here, since it is an under-absorption, the actual overheads is more than the absorbed figure. So the answer will be 47,500, which is D. Okay, it will be 47,500. All right. Right. So you can take this down. Again, this is another question. This actual absorbed under-absorption, another MCQ where they love to test this and trying to get the absorption costing profit from marginal costing profit. Those two are very, very common MCQs. All right. So that's it for the TRG. You can take this down. If you have any questions, you can drop it in the chat now. All the best for your exams. All the best for the rest of ACCA. Hope to see you guys in either an FM paper or some other paper in the skills level. As far as MA is concerned, you guys are done with the syllabus at this point. Okay. And, I know that a lot of people tend to, put MA as a hard subject. Okay. Because of course it's hard when you compare it to F3 or FA, because FA is something you would have already done in your A levels. Okay. So anyway, you're going to be good at it. So doesn't mean that FA is easy. It's just easy because you already know it. Okay. So my job, it has from the beginning of my ACCA journey, my job has always been trying to change the attitude that people have towards MA. Okay. And the reason is because, see, I don't believe in easy papers. You're not going to learn anything from it. Whereas MA is a paper where it is challenging, and only if it's challenging is it enjoyable. Okay, so I hope that at this point you agree with me that the MA paper is definitely enjoyable. When you're learning it, it's actually nice. It's not like BT, for example, where you're just learning theory after theory after theory. Okay, but again, I agree with you that the MA syllabus is a little long. Okay, if I had a say in this, I would definitely try to reduce the content of this syllabus. Okay, because it's a little long, and I feel the challenge is not understanding but remembering. So that's why I always tell my students at the beginning itself, I always say, try to have summaries. An example of which I gave in the variance summary. Yeah, like a summary for variance, the entire chapter. If you look at the study text, it will go on for pages and pages. But in reality, if you take the cream of what they're saying, it is only 3 to 4 A4 sheets. Okay. So like how I have given a variance summary, likewise, all the other chapters, it's easy to give summaries. Okay, if you want, I can display a few of them here to just give you an idea. Okay, because usually in my lectures, I try my best to give the summaries as well, so that students have nothing much to do. So let me just show that. So if you look at materials, you might feel that it's a chapter with a lot of information. Okay, but if you really, look into it in detail, let me show you this now. This entire materials chapter is summarized in 2 slides. Okay, so I'll just show you the 2 slides. One is this, okay, where we should know how to calculate the total cost of inventory. So there are 3 equations. We went through this, I think, in the last TRG, if I'm not mistaken. Then we have to know the different documents that you raise. You have to know about EBQ. We spoke about it. You need to know about EOQ and EBQ. And then you need to know about the inventories and the valuation methods. So this is the summary that you need for materials. Okay, so I'll give you a second. If you want, you can take a picture of it. This is accounting for materials. Okay, so this is one area. I'll show one more slide with some more equations. You will notice that these two slides are all that you need for accounting for materials. Okay, so if you find yourself stuck in MA, one reason could be that not that you can't understand, but you're having a problem remembering. So the best option would be for you to start summarizing chapters in such a way that you don't have a lot of information in a lot of places. Okay, try to bring it all to a few sheets of paper. It will definitely help. Okay, so this is one slide. And this is the other slide. Okay, so these are equations that we use when it comes to accounting for materials. Okay, so reorder levels, minimum stock, maximum stock, average stock. That's it. So if you have these four equations in your mind as well, that's all from accounting for materials, guys. Okay, so likewise, every chapter have a summary. Okay, because like I said, the trouble with MA is that the syllabus is long. Okay, so having summaries will definitely help. Having said that, the papers that continue from here, that is PM, about 80% is a continuation. A little bit comes in FM. In the skills level, definitely you will find those papers in terms of quantity, it's much less. For example, PM only has about 13 chapters, FM has about 18 chapters. That's it. Okay, so compared to MA, the volume is much less. Okay, so please, do yourself a favor and don't associate MA negatively in your mind. Because if you do that, you will have a problem for 2 skills level papers. Okay, so don't do that. Keep an open mind. Understand that this is another area that you also have to have expertise in. It's not difficult by any means. It's just up to you to make your life easier for you. Okay? Right, so having said that, I will end this TRG. Okay, I hope you benefited from it. If there is anything that we can do from our end, then you can always contact the admins and they will help you out. Okay, so if you are watching this on YouTube or any of the social media platforms, I think you will have our contact numbers in the description. And if you are you have joined the TRG and you are in this call, so in this call I think I have Sonali, if I'm not mistaken. Okay, she was here. Now it's somebody else. I think now it's Mohammed. So yeah, anything that we can do on our end to help, you know how to get in touch with us. Okay. So finally, if you feel that you're ready for MA, if you feel that everything is fine, close your eyes, go ahead, fix a date, sit for it. Definitely you will pass well. Okay. Just the thought that you are, you're thinking now, is this enough? Is this enough? That thought on its own means that you are ready. Okay, that on its own means that you're ready. Please go ahead and sit for the exam. Okay, I wish you all the best. I hope to see you at skills level papers, and yeah, all the best for your ACCA journey. All right. Okay, guys, have a good night.